Hey everybody, this is the Reynolds Mortgage and Real Estate YouTube channel, and I appreciate you tuning in. This week's topics, we're going to go over an important issue in terms of tax implications on properties or even other assets for that matter. But it's called capital gains tax. And what exactly is that, and how does that apply to you? So let's get right to it. What are capital gains? Capital gains refers to the profit made from selling an asset for more than you acquired it for. Asset types include stocks, bonds, and real estate. There are two different types of capital gains tax. There's short-term capital gains tax and long-term capital gains tax. Short-term is defined as an asset owned for 1 year or less, and that typically is taxed at your normal income rate. Long-term would be an asset owned for 1 or more year, typically taxed at a lower income rate, depending on your taxable income and also your filing status. So those are the two types. I drew up a quick example here. Excuse me. So for example, let's say you bought an asset for $10,000 and you decide to sell it after 18 months. Then you sell it for $15,000. So you made a profit of $5,000. And this is considered a long-term asset because it was more than a year. You would pay a federal tax rate of 15%, and the amount owed to the feds would be roughly would be about $750 if those are the numbers. So that does not include your state taxes. That's just the federal portion of it. So then when we go down a little bit more, let's see, how does this apply towards real estate? That's really what we're looking to get to here. Real estate, if you sell your primary residence, you are allowed to exclude up to $250,000 in profit, as long as it's $250,000 or less, if you are filing as a single person, or up to $500,000 if you're filing jointly. So let's say you acquire your property for $200,000. You sell it for 250. Let's say you sell it for $450,000. So you're making, almost $200,000 plus on that property. You would avoid that after your real estate fees and things like that. You'd be underneath the threshold there. But yeah, if you basically net over $250,000, you're going to be liable for that capital gains tax. So how can you avoid it if you are looking to take a house you owned and then turn it into an investment property and buy a new house? People do that all the time. So as long as within that 5-year period, if you decide to sell that investment, you owned it for at least 2 of the 5 years, you could then qualify for avoiding the capital gains tax, as long as the capital gains is under $250,000. So the key number there is $250,000. Owning it for a primary residence for at least 2 out of 5 years would also help you avoid it. But anything other than that, it would consider an investment, and then you're going to get hit with the capital gains tax. So how can we avoid capital gains tax on investment properties? This is a great opportunity to bring up a great option for people out there. It's called a 1031 exchange. And what that does, basically, a 1031 exchange allows you to defer taxes on investment properties that would normally be owed for that fiscal year. Essentially, you can take, let's say you sell a property, as long as you take those funds and you apply it directly to the purchase of another property, then you're going to avoid that tax. So it's a great way to kind of kick the can down the road, if you will, and avoid having to pay it now. Take an investment into a different property, and you'll avoid that tax. The cool part is, it doesn't have to be just a single family residence. It could be multifamily, which is 5 to 8 units. It could be buying mineral rights on land or even air rights above the property. So as long as you invest it in some sort of property, then you're going to qualify for it. So my final thoughts on it, it's very important as we're all getting older, people my age and stuff like that, as we're getting into owning houses, and these things affect us, and will majorly affect us if we don't do it correctly. It's just important to understand kind of how this stuff can affect us. So if you have any more in-depth questions, I would reach out to your CPA, see how it might affect your specific situation. If you need a great CPA, I know one, please let me know. And for more pro tips, hit like, subscribe, and follow. I hope you have a blessed weekend. Thank you.